are you then concerned of the possibility of disinflation or outright deflation? That seems to be where the trend of inflation is heading. Is that a
Yeah,
concern for you?
I think disinflation is the way to go here because if people become and corporates become more worried about the refinancing cycles at higher interest rates, they will slow down spending, they will slow down hiring, they will slow down capex, and so the labor market will slow, and so consumption will slow, and that is all disinflationary. And I think that's what we are seeing right now.
There are fragilities in the economy that may lead to a breakage, says our next guest, Alfonso Peccatiello, founder and CEO of the Macro Compass. Alfonso was on the show a few months ago, and you can revisit his macro calls and his outlook for the Federal Reserve monetary policy in the link here or down below. And we'll be revisiting his calls this time around and getting his updated outlook. If you're new to the channel, don't forget to like and subscribe and hit the bell notification to get daily updates on finance and economics. This episode is sponsored by NordVPN. Alfonso, good to see you again. Welcome back.
Hey, David, it's a pleasure to be here.
Congrats, first and foremost. You're launching a new hedge fund. Let's start with that. What's your strategy here?
Yeah, so I'm planning to launch a macro hedge fund. That's a fund that takes opportunities and from global opportunities around the world in all asset classes, bonds, equities, commodities, FX. I think macroeconomic volatility will pick up. It's already very high and it will pick up over the next 5 to 10 years. The US is running fiscal deficits at a ridiculous pace given where the economy is. The Chinese economy is under pressure. There are things going on all over the world, and investors can actually find a lot of opportunities out there in macro.
And what is your preferred asset weighting right now in your fund?
I think right now, the best possible risk reward asset is the front end of the US bond market. So short dated yields, like 2 to 5 years, but not even in the US. I think if you look elsewhere, like in Europe or the UK or in Sweden, you have these bond yields that are still priced way too high. And I think these central banks will be coming in cutting interest rates pretty aggressively. Canada as well, one of the places that I like.
Well, congratulations once again on the launch or the coming launch of your hedge fund. I'm sure it'll be a success. Let's talk about some of your views now. You tweeted just today that the economy may be seeing some fragilities. Macro fragilities are showing up outside the U.S. In your first part of the thread, you wrote that high interest rates are supposed to break something because an overly indebted economy will have to service a mountain of debt at expense rates and consumption. At expensive rates and consumption will slow. High rates were supposed to break the US because of government debt, but that's not how it works. And then you have a chart here showing the Fed funds rate with question marks at the end. What are these question marks, Alfonso?
Well, this question marks, David, is that if you look at this chart in the past, every time the Federal Reserve has hiked interest rates aggressively, something has broke at the end of the day, right? And so this time it seems to be somehow different. But the reality is that it's not that government debt is the immediate problem when you hike interest rates, but it's private sector debt. So if you and I are overly indebted, if corporates are overly indebted, David, what happens is when you raise interest rates and you are forced to refinance, then if your salary hasn't gone up or your corporate earnings haven't gone up, hey, you have a problem because all of a sudden you need to allocate more money to your debt servicing costs. And that is the mechanism that normally slows down the economy, right? Because instead of spending and doing a lot of travel and restaurants and discretionary spending, hey, if you have to refinance your mortgage at 7 or 8%, you're going to be thinking twice, right? Because a larger share of your salary will need to go to debt servicing costs. And so the debt service ratio, that is the metric, the most important one to take to keep track of, because it measures how much of the private sector income is getting used to cover that costs, basically.
Okay, and the counter argument here is that the interest rate has been high for quite some time, Alfonso, and the system hasn't completely broken down yet,
Yeah.
unless we've already seen some cracks. So how would you respond to that?
So I would say if you look at the US, the debt servicing cost has gone up to 15%. The debt service ratio is 15%, 1.5. That's exactly in line with the last 20 years, not much higher than that. And why it has gone up so slowly, David, is for three main reasons. Well, first of all, in the US, you don't have any floating rate mortgage, any floating rate corporate borrowing. Everything is on a fixed rate. So once you fix it, and most companies and households did before the Fed hiked the interest rates, well, then you don't need to refinance for a long period of time. So the Fed is hiking interest rates, but you don't really feel the negative effect because you don't have to refinance your interest rate. You have fixed interest rate for a long period of time. And then the second main reason is that the US private sector debt level is actually not that high. in percentage of GDP, US private sector debt today is slightly lower than it was in 2007. Why? Because in the US, who's done the big borrowing, the big leveraging has been the government of the United States, while the private sector has been more conservative. So that means in the US, you get the negative impact of higher interest rates, but it takes longer. It's much slower. You want to know a few countries that instead have a high debt service ratio? These are the countries where the cracks are already showing up. Canada, Sweden, Australia. These are countries where the debt service ratio is already higher. And these are countries where GDP is already growing at 0% effectively.
On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. Private debt levels instead reveal the true macro fragilities of economies facing higher interest rates, you wrote. The private sector doesn't have the luxury to print money. If you get indebted to your eyeballs and you lose ability to generate income, the pain is real. Yes, but I will add the private sector has the ability to raise money through more equity rounds, or perhaps another lending facility with the bank, or perhaps bond issuances, if their investors allow.
Yeah, that is correct. Now, the issue is that normally buying a government bond, so think of the government. If the government does the same exercise and wants to kick the can down the road, David, government bonds are generally forced on investors by regulation. Banks have to buy government bonds because of regulation. Pension funds have to buy government bonds because of regulation. They don't need to buy necessarily corporate bonds or mortgage-backed securities. Those are more risky, and you need willing buyers for these credit instruments, right? And so you can still find them, but it's harder. You cannot print money as easily as the government can. From the private sector perspective, it's much harder to kick the can down the road as it is for the government. So if you look at all crises in history, they all come from private sector leverage. You want to name a few? The Japanese real estate bubble crash. Well, that was because the Japanese real estate market and the private sector was too leveraged. You look at China today, you have the same problem. Private sector leverage is too high. You look at the Spanish housing crisis of 2012, the Asian tiger crisis. All of them come because of high private sector debt levels.
Yes. How much does the inflation level, so higher inflation with lower inflation, play on the ability of a company to either pay off their debt or raise more debt?
Yeah, that's a great question. So inflation is debt, private sector debt is the most painful when it has to be refinanced at high interest rates and your nominal income is not going up. Mm-hmm. So when in real terms, your debt costs go up, that's when it's the most painful, right? So inflation helps borrowers. Inflation helps debtors because their due amounts get inflated away effectively, right? Okay. So what really matters is the real cost of refinancing, the inflation adjusted cost of rolling over this big debt and these big liabilities. And I would say also that has been going up lately because inflation has been coming a little bit more under control in many places, including the US, but the interest rates instead are still very high. So what borrowers are finding here is high refinancing rates, but inflation rates that are clearly coming down and economic growth that is also clearly coming down. And that's the worst possible combination for highly indebted borrowers.
Are you then concerned of the possibility of disinflation or outright deflation? That seems to be where the trend of inflation is heading. Is that a concern for you?
I think disinflation is the way to go here because people become and corporates become more worried about the refinancing cycles at higher interest rates, they will slow down spending, they will slow down hiring, they will slow down capex. And so the labor market will slow. And so consumption will slow. And that is all disinflationary. And I think that's what we are seeing right now. And there are places where this has already gone on much faster, namely China.
Yeah.
China is in outright deflation now for a few quarters and counting because the private sector was too leveraged and the government has tightened up the screws on the real estate sector. And so now you're getting this deleveraging, you're getting this big refinancing issue, and the economy is slowing down so fast that deflation is happening over there.
I want to come back to inflation and the Fed in just a minute, but continuing with your thread, countries like Australia, Canada, Korea, and Sweden are all under pressure. Their DSRs are high in absolute term and higher than their 20-year average. And the trend is also negative as they keep increasing over time. So, yeah, some of these countries you mentioned have high debt to GDP ratios, but not as high as countries like Japan, Italy, where you're from, right? These countries aren't falling apart right now. So what's going on here? What's the difference?
So, for example, take Japan. Japan has a very high government debt to GDP ratio. Also, Italy is a very high government debt to GDP ratio, right? So
Yes.
that's the story. And they especially for Italy, the ECB has raised interest rates. So refinancing Italian debt is more expensive, but they still can. They can still issue Italian bonds, and investors are buying them because banks are forced to buy them and pension funds are forced to buy them. Okay,
Mhm.
so the pressure, the macro pressure coming from high government bond yields on a country with high government debt is not so high if you're issuing your government debt in your local currency, in euros in this case for Italy, in Japanese yen in this case for Japan. What is happening in Japan instead is different because Japan is seeing their currency devalue pretty aggressively because the Bank of Japan is refusing to adjust interest rates according to the inflation picture in Japan. Inflation has been running way north of 2% in Japan, and these guys have only done a 10 basis point hike so far. 10 basis points. So if you look at all other currencies in the world, interest rates are much higher. And clearly, what people are doing is they're buying other currencies and they're selling the Japanese yen against it, the so-called carry trade in FX. And this is putting pressure on the Japanese yen. But it is not something that comes from pressure on government bonds or government debt because these government bonds are issued in local currency, in domestic currency. The fragilities come when the private sector has to refinance at higher interest rates because they cannot print money and the government can print money instead.
Speaking of Japan, I'm going to show you a very interesting chart here.
Yeah.
Um, so here is a chart showing the Japanese yen versus gold. And as you pointed out, the weakness of the yen actually is correlated with the gold price going up together at the same time. This usually doesn't happen in the past. I wonder if there's a broader narrative here.
That's a very good question. So I would say the strength in gold has been impressive. It's an asset I've liked for several quarters. So what's going on in gold is pretty simple. I would say it's the combination of two things. The first one is that inflation numbers and wage growth numbers in the US have surprised to the upside in the first quarter of this year. Okay. And what has Powell done? What has Powell done, David? At the last press conference, they've asked him, hey, Mr. Powell, inflation is stronger. Are you thinking about hikes? And be like, hikes? What do you mean hikes? Are you kidding me? What hikes? I want to cut rates as soon as I can, please. And so,
Yes.
of course, if the economy is still running relatively strong and inflationary pressures are still there, but the Federal Reserve only wants to talk about cuts, well, then gold does pretty well, right? Because it's a protest from financial markets against monetary policy authorities that are not adjusting their monetary policy according to the economic conditions. And the second reason has been that clearly central banks around the world are slowly but surely allocating more of their reserves away from bonds into gold. It's a steady, slow process that goes on in the background, and that has really helped gold.
Why is it that gold and the dollar have been moving together? They're inversely correlated usually.
Yeah, it's a great question too. But so gold has been rallying versus the dollar, but the dollar has been rallying versus the Japanese yen, the euro, the sterling, and so on and so forth. And why? Well, because these central banks are even more dovish than the Federal Reserve.
Hmm.
These economies are weaker than the US. So the dollar appreciates versus the weakest guys in the links, right? The weakest links out there. So let's say the Japanese yen, the Swiss franc, the euro, all these currencies are getting clobbered against the dollar. But the dollar is getting clobbered against gold. And it all makes sense. It's like a pyramid. It's like a scheme, right? Where if you look at the dollar is stronger against other currencies because their economies are weaker. Their central banks are less credible. They really want to cut interest rates even faster. If you look at the ECB, if you look at the Bank of Sweden, if you look at the Swiss National Bank, they're dying to cut interest rates, David. Their economies cannot handle this level of interest rates. And so they're more dovish than the Fed. And so the dollar does good versus them. But then if you look at the dollar versus a bigger opponent like gold, well, then it's not doing well either. Then I think this is like a chain that you need to follow, and it makes all the sense in the world.
Okay. So ultimately, going back to your debt situation here that you've outlined, what does this mean for investors?
Well, I would say that if you're an investor right now and you're invested in countries that have tried to hike interest rates as fast as the US, for example, the UK or Europe or Canada or Australia, okay?
Hmm.
You're invested in these countries. They've tried to hike interest rates as much as the US. They've kept policy rates that high for so long. You should be a bit careful here because these countries, Canada, Europe, UK, Sweden, and more, they are not as equipped to handle high interest rates as the US is. They're more vulnerable, they're more fragile, and these fragilities are showing up. So people always like to talk about US markets, but there are other markets out there where people might be invested. Europe, Canada, Sweden, and so on and so forth. And these economies look pretty vulnerable here.
So if the private debt is what really exposes the economy's fragility, well, one could argue that even if the central banks lower their policy rates, private debt rates may not immediately follow. I'll give you an example. Okay, I know somebody who works at a bank. I'm not going to name which one, but he works for the credit card department. He told me that credit card rates are likely to go up this year, not down. This is in Canada. And this is because he says interchange rates are going down. And so they have to make it back with raising credit card rates. All I'm saying is that even if the Bank of Canada lowers rates, it's not going to affect consumer debt, right? Same thing for corporate debt.
So what you're talking about is credit spreads, right? I mean,
Yes,
the rates for the private sector are not the same that for the government. Of course, you are not the government, so you need to pay more to borrow, right? You're less credible according to investors than the government, so you need to pay a credit spread on top. And as the economy weakens, David, in history, every time you go and check, when the economy weakens fast enough and worryingly enough, credit spreads go up. Why?
mm,
Nobody wants to lend at the same low rates to the private sector or to a
that's right.
corporate if the economy is weakening. And so it's a vicious circle. Eh? The economy weakens. Maybe a corporate would like to borrow some money to have a cushion. Well, all of a sudden they find out it's more expensive. Or the same goes for credit cards. It's a vicious circle that only happens close to recessions.
Yeah, that's right. So that's exactly the point I was making, Alfonso. You summarized it better than me. It's just even if the central banks give us some sort of relief, well, we may not necessarily see it in our private debt right away. So on that note, do you think the Federal Reserve in the U.S. will cut rates anytime soon this
Yeah.
year? What is your thesis here?
Yeah, I think they will cut rates. They're hoping and praying that the next inflation data gives them a window to start cutting interest rates. You can really hear that even after a full quarter of stronger inflation data, all Powell wants is talk about when are they going to cut. Really, seriously. So he wants to cut rates.
You know, he did surprise, I would say, most people I talked to. I remember this conversation we had, not just you and me, but I had this conversation with people 5 months ago. Everyone was
Mhm.
expecting a cut by now, right?
Yep.
And now the conversation is literally what he said, what Jerome Powell said, higher for longer. He said this mid-April. And
Yeah.
so we're wondering what changed.
Well, I would say that if you listen to him at the last press conference, even after a full quarter of data, he wanted to talk about some cracks showing up in the labor market. I mean, you're the chair of the Federal Reserve. If inflation has been strong, you normally are expected to say, well, we're going to keep rates here, even think about hikes. And he instead wanted to talk about when are they going to when are they going to start cutting rates. To me,
Yes.
overall, it's all going to be about macro data. And I expect the labor market to slowly weaken a little bit more going forward, inflation to come down a little bit more going forward. All of this is going to be like manna from heaven for Powell. He's looking to start cutting interest rates. So at this point, I would say July is for me the starting date of the Federal Reserve cutting cycle. And then I expect them to cut 2 or 3 times this year. But importantly, it's all going to be about how much growth and inflation slow down going forward. Economists are expecting US GDP growth to be 2.5% in real terms this year as well, and inflation to be 2.5. I mean, 5% nominal GDP growth again. I think the consensus is getting very excited, very optimistic here.
By the way, let's close off on this. The president of the WEF was at a summit, I think, a few weeks ago. I was reading this article, and he noted that global growth used to be above 4%. Now it's under that, about 3%, perhaps even lower in some regions. Is this a concern for you, or is this just showing maturity in a lot of developing areas?
maturity in the cycle. That's what it's showing. And I think it's typical, like in 2007, that people want to throw in the towel
Yeah.
on the recession. And even they start talking about hikes are stimulative. I heard this last week, David, that interest rate hikes are stimulative for the economy. These are these theories that show up always at the end of the cycle. Like in 2007, you had the IMF and the Federal Reserve telling us we were in the middle of soft landing. The reality is that we are in a very mature growth cycle. And I think it makes sense to look at potential weaknesses going forward.
Okay. Alfonso, excellent summary as always. We'll have you again on again soon to get you to get another summary update. Where can we follow you in the meantime?
Yeah, the easiest way is on Twitter at MacroAlf. And if anybody wants to know more about the fund, they can simply send me an email. fund@themacrocompass.com is the email address. I will reply personally.
When is the launch?
The launch is in Q4 this year.
Okay, we'll look forward to that. So congratulations again, and we'll talk before Q4. Absolutely.
Thanks, David. Talk soon, guys.
Thank you, and don't forget to follow Alfonso, like this video, and subscribe.